Good afternoon, ladies and gentlemen. Welcome to Bank Millennium conference with third quarter results. Let me introduce bank representative present today on this conference. We have Chief Executive Officer, Mr. João Brás. We have also Chief Financial Officer, Mr. Fernando Bischu. We have also Chief Economist, Grzegorz Maliszewski. My name is Artur Kulesza. I am heading Investor Relations. We start with a short macro presentation, followed by then results of the bank, and followed by Q&A session. So the first part will be conducted by Grzegorz Maliszewski, Chief Economist of the bank.
Good afternoon. Let me start with a brief summary of macroeconomic environment in Q3. There was a stable interest environment in third quarter. Polish Central Bank kept interest rates at record low level and suggested strongly to keep them stable in coming quarters. This was in line with our expectations because we assume stable interest rates in coming quarters and expect first rate hike not earlier than at the beginning of 2018. Market adjusted to this more hawkish scenario because a few months ago it expected rate cuts, so yields of Polish bonds went up, especially in longer end of the curve. We expect this trend might continue mainly because of global trends. Moving to economic growth and economic environment. Third quarter showed stabilization of GDP growth at around 3%. The main driver of the economy was private consumption that is supported by improving situation in the labor market and record low unemployment rate. In the same time, there was a third consecutive quarter of decrease in investments in fixed assets, mainly because of contraction in public investments. With no investments recovery in coming quarters, it might be difficult to speed up economic growth, so we expect it might hover around 3% in coming quarters. On the inflation side, not much to report because deflation is diminishing gradually and should turn into positive territory in December and reach around 1.2% on average in 2017. Zloty appreciated slightly during Q3, supported by improved global sentiment and better risk perception. Moving to monetary aggregates. Nominal dynamics of households loans remained moderate. However, it accelerated slightly to 4.8%. However, nominal dynamics volatility was affected by FX changes, while excluding FX factor, annual growth of loans to household remained at around 4.3%. In the corporate sector, loan dynamics went down to 1.9%, reflecting low investment activity of corporate sector. This was visible in lower growth of loans to non-financial companies, but mainly in negative dynamics of loans to local governments. On the other side, low investment activity was reflected in still pretty solid growth of deposits in corporate sector. However, its dynamics decelerated to 6.9% year on year, partially because of lower growth of deposits in non-financial companies, because in local governments annual growth of deposits exceeds 20% year on year. In household sector, growth of deposits remains solid, it decelerated slightly to 9.9%. This was driven mainly by strong growth of demand deposits, while dynamics of term deposits remains much lower at around 3.2%. Thank you.
Thank you, Grzegorz. So now I will follow with the main financial highlights of the first 9 months of the year, and I will start with the slide number 8. In the first 9 months of 2016, we had a net profit of 570 million zlotys, which is 15.5% higher than 1 year ago. Specifically, in the third quarter, we had a net profit of 139 million, already after 47 million zlotys of banking tax. Return on equity on a yearly basis is at 11.4%. If we exclude one-off items, it would be at around 7.9%. We continue to show a consistent growth of operating income, and especially of core income, which is higher by 4% year-on-year and 2.3% quarter-on-quarter, mainly thanks to better net interest income on a yearly basis, but also supported by better performance in terms of commission income in the third quarter, in which we booked commissions 7.4% higher than in the second quarter. In terms of asset quality, it remains very good, and with an impaired loan ratio stable at a very low level, 4.6%. And the cost of risk also lower than 1 year ago at 45 basis points over total net loans year to date. On the capital side, we had another strong improvement. At the end of September, we had a consolidated total capital ratio of 18% and a common equity tier 1 ratio of 17.8%, and this is strongly above the updated new regulatory capital thresholds that I will explain in more detail later on. Also, we continue to have a very high level of liquidity, and the loan-to-deposit ratio further improved to 85%. So moving now to more details, and starting with the evolution of profitability and operating income on page number 9. As I mentioned, we are having, up to now, year to date, a growth of net profit of 15.5% year on year. If we would exclude the one-off incomes and costs, especially the ones booked in the second quarter, and also if we would exclude the impact of the banking tax, we would have a net profit higher by 5% versus the previous year. The return on equity at 11.4% compares well with 1 year ago, in which we had 11.1%. We continue to show a strong increase of operating income by 16% year on year in the first 9 months of the year, of course positively affected by the Visa transaction in the second quarter. And also when we look just at the third quarter net profit, this was a quarter already without relevant one-offs, so it can be more directly comparable with the first quarter. We just need to remember that in the first quarter we had only 2 months of banking tax. Now we had already the full quarter, and so if we would eliminate this impact, in fact the third quarter net profit was 12% higher than the underlying and comparable net profit of the first quarter. In terms of the core income, which is the relevant item to follow in terms of the improvement of the operating income, we continue to show a consistent trend of improvement with a growth of 4% year on year, 2.3% quarter on quarter, and also when we compare the core income of the third quarter versus the first quarter, there is also a relevant improvement. Explaining in more detail the evolution of net interest income, we had in the third quarter a growth of less than 1% in net interest income versus the previous quarter, But on a yearly basis, we have an accumulated almost 9% growth of net interest income. We continued to improve the cost of the deposits. In the third quarter, we had a further decrease of 8 basis points versus the level of the second quarter. On the other side, this was partially offset by lower remuneration from loans. And also we need to take into consideration that the loan portfolio is not growing. In fact, it slightly fell in the third quarter, which also did not help. But clearly we have a positive trend, and the year-to-date net interest margin at 2.37% is clearly higher than the 2.19% that we had in the same period of last year. Regarding commission income, it was a good quarter. We had clearly better commissions versus the second quarter by 7.4% at 150 million zlotys. And so this negative comparison versus the same period of last year is getting better. Still year on year we have lower commissions by 7%, but going forward this difference should get smaller. The third quarter positive evolution was made mainly due to the improvement in commissions from investment products and insurance fees, as well as rebound in credit cards. Regarding trading income, we did not have any special one-off, so we came back to a more normal level. On the cost side, costs were lower by 1% quarter on quarter. On an accumulated basis, they are slightly higher by 2.3%, but here nothing new is happening. We keep a very strict cost discipline in place. We continue to improve the cost to income, not only the reported one, which clearly is better than 1 year ago, so at 43.9% year to date. But even if we exclude extraordinary items, we have a cost to income of 50.1% year to date, and in the third quarter alone of 49%. So here we continue to go into the proper direction of gradually reducing the cost to income ratio. And this is also being supported by the optimization of the number of branches and that we have announced and that we continue to execute. Asset quality, nothing new, a stable impaired loan ratio, also relatively stable situation in the different portfolios, also nothing new in terms of past due over 90 days. The cost of risk in the third quarter was still supported by recoveries of NPLs, especially in the corporate segment. This is helping to keep the cost of risk of corporate in this year exceptionally low. And so we had, in fact, in the third quarter, 52 million zlotys of provisions, which represents 45 basis points over total net loans in the quarter, which is exactly the same average cost of risk that we have year to date in the bank. And also, last but not least, the coverage ratio of impaired loans remains stable. On the capital side, so first of all, the graph on the left side shows clearly the significant improvement of the capital ratios that we have been doing in recent quarters. In the third quarter, further improvement of the total capital ratio to 18.03%, common equity tier 1 ratio to 17.8%. Already in October, there were two important developments in terms of the regulatory capital thresholds. On one side, the new capital buffer for other systemic important institutions, which in our case is 0.25% to be covered by core tier 1 capital, and the update of the buffer for FX mortgage, which was set now at 3.09%, a decrease of 74 basis points versus the previous 3.83%. So if we put everything together, so the different capital buffers and the different past recommendations from KNF, we come to the situation that we need to comply with a total capital ratio of 16.3%, a Tier 1 of 12.8%, and a Common Equity Tier 1 ratio of 10.7%. And as you can see, these we are complying with these new regulatory capital thresholds in a very comfortable way, especially in terms of total capital ratio now with more than 1.7 percentage points higher ratio than the minimum required. On the liquidity, due to the trends in terms of volumes of deposits and loans, we had a further reduction of the loan-to-deposit ratio to 85%, and as a consequence, the portfolio of liquid debt securities as a percentage of total assets increased to 23%. Moving to the third part of the presentation regarding business development, the most important success that we have been achieving in recent quarters is the significant growth in the number of active customers in retail. The third quarter was very strong, 37,000 net growth of active customers in retail, which brought the last 12 months growth to more than 100,000, 107,000 net growth of active customers in retail. We believe that this is the foundation for the future growth of the activity of the bank, and so we see that's why we stress that this is probably one of the best achievements of the recent quarters. On the back of this, it is also supporting the higher than market speed of retail deposits growth that was kept. We have been growing 16% year on year and 2% quarter on quarter. On the corporate side, a growing number of transactions with corporate customers. On the lending side, we had some stronger growth of PLN mortgage sales, especially when compared with relatively low base of 2015, with a year-to-date origination of 691 million zlotys. And on the other side, we had seasonally lower sale of consumer loans with 512 million zlotys in the third quarter. On the corporate side, strong sales of leasing and factoring. In terms of quality and innovations, we were the only bank that was on the top 3 in all categories of Newsweek quality ranking, showing the consistency of the strategy that is being developed in retail. We continue the branch optimization process with a reduction of 13 branches in the third quarter. And we continued the significant pace of growth in alternative channels with more than half a million active users of mobile solutions, which translates into a growth of almost 50% on a yearly basis. On page 17, the loan portfolio is basically flat on a yearly basis, even with a small reduction of 1% on a quarterly basis, mainly due to the fact that we had a further reduction of the FX mortgage portfolio, which was not fully compensated by the growth of non-mortgage retail loans. And on the other side, also the portfolio of corporate leasing and factoring together was flat versus the previous quarter. But as a consequence of these trends, we continue to change the structure of the asset mix with a lower share of mortgage, especially of FX mortgage, and the increase of the share of other retail loans. It's important to notice that we are still having a double-digit growth of non-mortgage loans, non-mortgage retail loans that grew by 11% year on year. In terms of customer funds, the growth was solid, by 5.2% year-on-year and 2% quarter-on-quarter, but especially with a strong growth of deposits by 6% year-on-year, and in fact with a much stronger growth in retail deposits. The good news is also that in the third quarter we see clear rebound in terms of investment products. It is visible here already in this graph on page 18. And on the household deposits, we continue to have a faster than market growth at 16%. As we saw from the macro part, retail deposits are growing slightly below 10% year-on-year in the market. And on the other side, our more restrictive pricing policy in the corporate deposits, and also due to the fact of the very big excess of liquidity, this implies on a yearly basis some reduction of corporate deposits, although they already increased in the third quarter. When you look at page 19, you can see the very strong and solid growth of the number of customers of the bank, the active retail clients. We are in a growing path. After growing 18,000 in the first quarter, net growth, we grew 27,000 in the second and now 37,000 in the third. So this brings the accumulated growth in the last 12 months to 107,000. Let me remind you that the target for this year was to grow 100,000 net active customers in retail, and if we keep this run rate, we are clearly on track to beat that target. This growth is strongly supported by the growth of current accounts. We have already more than 500,000, 360 accounts since the launch of this product in 2014, 1/3 of which was sold during the first 9 months of this year. There is a significant active usage of this account. 97% of the users have debit cards, 65% actively use internet, and 36% make transactions by mobile applications. So these are very good indicators. We also had a strong growth of overall payment cards to 1.8 million in September this year. Moving now to page 20, looking at the evolution of customer funds, I already stressed the very good performance in terms of the growth of retail deposits by 16% year-on-year. But even more important is also the change of the structure of retail deposits, with a much stronger growth of current accounts and savings accounts, which together grew by 32% year-on-year and already represent more than 55% of total deposits from individuals. On the other side, we had, as I mentioned, a rebound in non-deposit investment products in retail customers, which were already higher by 3.7% versus the end of the second quarter. In terms of market share of deposits, we continue an upward trend, already at close to 5.8%, so also in line with our target of having a market share above 6%. On page 21, loans to individuals, basically flat, even a decrease in the third quarter due to FX impact, but with the change of the mix that I already mentioned, and we continue to grow double-digit in cash loans, which is the product that we want in which we want to increase market share and also a higher share in terms of total retail loans. In terms of the origination of loans in the recent quarters, we had some decrease, seasonally decrease in the third quarter in cash loans, also due to some adjustments that we had to do in the process of origination of cash loans. And on the other side, the year-to-date production of mortgage is 44% above a year ago, although the base is still relatively low. On page 23, you can see the strong numbers that we are showing in terms of the electronic channels usage. Most important, we have 940,000 retail clients active in mobile and online banking, which is 14% above 1 year ago. We have 521,000 customers from retail actively using mobile applications and mobile Millennium, which is 46% year-on-year. And we also have relevant numbers in terms of different transactions and services provided through our platform, especially the importance already of this channel in terms of origination of cash loans and overdrafts. Pages 24 and 25, I will not go through details, but just illustrate the developments that we have been making both in Millennet and in mobile applications in order to keep a leading position in terms of the providing to our customers very advanced solutions for transactions and services, and including a much smoother process in terms of cash loans through online. Also, the planned launch very soon of motor insurance completely done through internet. And we expect that this will drive further transactional activity by our clients. On the corporate side, portfolio has been basically flat, even a slight decrease quarter on quarter, although we continue to grow well in leasing, where year on year we have a growth of the portfolio by 13%. We have kept here on one side the target of increasing our loans to companies, but on the other side also price discipline. So, and due to the fact that the market is growing at a relatively low rate, as Gregor showed before, loans to companies are growing year on year less than 2%. This is making more difficult also our growth in corporate loans. Regardless of this, let's say, flat portfolio in corporate, we see important improvements in terms of the activity with corporate customers, with a growth of 13% of domestic payments, and 33% of the volume of FX transactions. On the deposit side, already a rebound in the third quarter, but as I mentioned before, the reduction that we have year on year was mainly driven by stricter pricing of time deposits from corporates. On the other side, we have a good growth of current accounts from companies. Finally, on page 28, the numbers from leasing continue to be strong. Origination of leasing higher by 11% year on year, of factoring higher by 13% year on year, and market shares stable at around 6.5% for leasing and at around 10% for factoring. So thank you for your attention, and now we will be available for questions.